Now, to help understand the influence and actions of central banks, I'm delighted to introduce our first guest speaker, journalist, author and former Wall Street banker, Nomi Prins. Nomi is extremely well placed to talk on this subject. She's worked on Wall Street as Managing Director at Goldman Sachs, Senior Managing Director at Bear Stearns in London, strategist at Lehman Brothers and analyst at Chase Manhattan. She's spoken at the Federal Reserve, IMF, World Bank Conference, and she's regularly appeared on many TV networks, including CNBC, CNN and the BBC. I've just finished reading Nomi's last book, All the President's Bankers, and it's a truly fascinating account and an eye-opening account of the relationships between the leading bankers of the day and every US president since 1914. Her latest book, due out in a few months, is called Artisans of Money, and it's an account of the rise and the influence of the Federal Reserve and central banks. Now, Nomi should really have left Wall Street to take her next career move in the Federal Reserve or at the White House, but she turned author. And in a conversation, I asked Nomi what her former colleagues have to say and how they view her journalistic work. I actually expected her to say they want to shoot me. So, please give a warm welcome to Nomi Prins.
Yeah, I didn't tell Steve that they want to shoot me exactly, but there have been words. First, I just wanted to thank Steve and everyone, all you guys, for coming as well for this. I think what's going to be a really informative day. I had the benefit of having dinner last night with Steve and some of his colleagues and Claudio, and we managed to dissect. Can you not hear me? Oh, sorry. So I had the luxury yesterday of having dinner with Steve and Claudio, who's going to be speaking to you this afternoon, and Steve's colleagues, and we basically dissected the world from the standpoint of central banks, governments, where we've been, where we're going. It was very informative, and at one point during dinner I turned to Steve and I was like, I wish you all could have been at our dinner because we really covered everything last night. But the good thing is you're here today, and we're going to cover a lot of things. So thank you. As Steve mentioned, again, I've worked on a number of places in the banking industry. Two of them no longer exist. That's Bear Stearns in London. I had started at Bear Stearns in London in the early 90s. We were the first office to take occupation basically of one of the floors in Canada Square. So if you know Canary Wharf now, it's pretty active. When I started at Canary Wharf, and in one of the buildings there was one place to get food on our premises, and that was from a fruit lady that basically sold plums and peaches and stuff downstairs. And then there was a Billingsgate fish market where one could get fish. I'm a vegetarian, so I was really stuck with the fruit lady. And then ultimately she was kicked out and other people came in, and now it's, you know, this sort of metropolis over there. So things have certainly changed, and Bear Stearns no longer occupies any space there or anywhere. So things have changed. I want to talk about, though, you know, Steve mentioned what's happening and how the markets since the financial crisis of 2007, 2008 have really been impacted by central bank policy, and just maybe step back and talk a little bit about what central banks are for a second and central bank policy. And there's a really good definition on policy on the Bank of England's website. And it says that one of the tools that the central banks have used to basically buy assets and to keep the markets up and do this sort of reflation or try to artificially put money into the system in order to keep the price of assets, including government securities, up, it says it's an unconventional method. So unconventional method, which has now gone on almost 10 years. So we're in an unconventional 10-year and moving on period where electronic money is created to buy assets such as government bonds. And so it's not quite like printing money. We're a little more high-tech than that, than it used to be in terms of actually printing money to buy these securities. It's electronic now. But the Bank of England is basically saying it's not normal. And they're involved in it. They've certainly not involved as much as the Federal Reserve of the United States has been involved in pushing this sort of coordinated policy of non-conventionality. But they are involved. And if you want, there's also a little video that I looked at last night. I'm on jet lag. I came in from LA yesterday, so it was sort of 1 or something. And there's a little 3.5, 4-minute video if what you get here today isn't quite enough for you, where you have cartoon elements of sort of there's bonds, there's little chunks of money bags, there's all sorts of things going on, and effectively there's this voice that comes on and says that they're substantive ways to put money into the system and try to get it to grow. But it's not the central bank's role to really get the economy to grow. This is what central banks have been saying as the defense to the policy that they have followed since 2007, 2008. Going back even further than that in history, about 100 years before this financial crisis happened in 1907 in the United States, there was a big bank panic on Wall Street. And panics or crises in credit and finance, they're really all about the same thing. Someone or some group bets too much, sucks people in, comes out, and everything implodes. And there's some element of what do we do now, how do we pick up the pieces? And in 1907, there was a relationship between J.P. Morgan, who was the most important banker in the United States and arguably the world at the time, who was called upon by the President of the United States, then Teddy Roosevelt, to sort of fix the problem. And I did talk about this in the book before getting into more recent history. And what Teddy Roosevelt said was, here, I'm going to give you $25 million from the Treasury Department in the United States, and just figure out what to do with it to make this problem go away. And what J.P. Morgan decided to do was not to really fix the problem. He invested some of that money and made money off of it, like sort of bankers do, and he gave it to his friends. So the banks that had made the biggest bets, the equivalent of Lehman Brothers, which fell apart in September of 2008, and Bear Stearns, which fell apart or started to fall apart in March and fell apart in the middle of March 2008, so basically 9 years ago, banks like that weren't saved any more than they were saved 100 years later. What happened was the friends of J.P. Morgan got money, and then J.P. Morgan stepped back and he said, you know, I don't want to have to be in a position where my friends and my business, and when I say friends, I mean people that invest in my bank, are going to be hurt if other silly banks go belly up. So he basically decided to push this idea of having a United States central bank that would centrally provide liquidity, provide money into the system, first into the banks of the system, first into the biggest banks of the system, in case there was a crisis, to sort of keep things going. And so what he did was, not personally, but he had a membership at a club called the Jekyll Island Club in the United States. And it's the building on the Jekyll Island Club, it's not quite as old as the building that we're in now. I think Denham Court, somebody gave me some information on this. Parts of this building are 700 years old, and more of it is 18th century. So Jekyll Island Club had a main building that was basically 19th century. And it's where all of the wealthiest industrialists and bankers in the United States would gather. They'd have to have a membership at this club, mostly once a year. So it was mostly around sort of the Christmas time, New Year's holiday. And they would come down with their families and their kids, and they would have to sail down because it was an island. The Jekyll Island Club was on Jekyll Island. And it was very, very discreet. You couldn't get there if you were sort of a mere mortal. You couldn't, now there's a causeway. You can actually drive there. It's a hotel. It's really nice. Like the closest thing we have to Downton Abbey in the States, you know, in terms of a building. And you can go there and be there, but at the time you had to have a membership, or a member had to sort of bring you in. And so what J.P. Morgan did was he worked with a senator. So this is the relationship between private bankers and Washington and senators named Nelson Aldrich, who had done a lot of time, had come to Europe quite a lot, and sort of saw what the Bank of England was like, saw what the Bank of France was like, and said, we're going to have something like this in the United States, only it's going to help our banks just a little bit more. And he came back and he convened under J.P. Morgan's membership a bunch of bankers to decide what the United States should have. 3 years later, long story short, we have the 1913 Federal Reserve Act, which creates the Federal Reserve. So the whole point is that that central bank came out of crisis, followed by a major private banker saying we need to have extra help because we don't actually trust the Treasury Department. We don't trust that the government's necessarily going to have enough money to be able to help us. Then it became an act, and then it became a law, and then it became the Federal Reserve. So their job from almost day one was to really save the banking system and, as an afterthought, perhaps help the economy. But what happened was we had World War I, and the United States wasn't involved in World War I in the beginning, but it had this sort of new toy that was created at the Federal Reserve to help supply money into the private banks that helped to fund part of the war, and also war bonds, which were part of the government and private bank connection that also helped to fund the war. And then ultimately, of course, the U.S. was involved in the war. And at the time, J.P. Morgan's son, Jack Morgan, went to our President Woodrow Wilson and said, don't touch the Fed. We need it now more than ever because there's a war. And so it was solidified also for other more geopolitical and military reasons than it had been created for banking and finance reasons. And it still plays that role. It's just that the geopolitical and the military aspect is very, very, very under the carpet. But as investors, and this is where Steve is so good, because understanding sort of the history of how and why things like that, central banks are created, and what their mission was and what it has evolved into, really helps you understand why we've had an almost 10-year policy of what I call artisanal money, or the sort of the creation of both electronic money, keeping rates down, keeping rates negative, and this whole idea of continuing to funnel from an outside source, from central banks, money into the system to help the system under the guise of promoting growth in the economy. But in most cases, growth has not followed the evolution in stocks. And so even though you have PE ratios getting back to 1929, where there was a crash because bankers were basically not supervised by the Federal Reserve, and the promise was the Federal Reserve would also supervise the banks, and especially after 1929, they did a really bad job of that going into the crisis that we just had. But also, we have much more risk in the system now because of this artificiality. So all told, between the Federal Reserve, the European Central Bank, the Bank of England, and the Bank of Japan are effectively, and this is where the geopolitics come in, the G7 central banks. There's about $12 to $13 trillion worth of this electronic money that has been pumped into the markets over this period since 2007, 2008 to buy sometimes government bonds, sometimes equities, like in the case, or stocks in the case of the Bank of Japan, sometimes corporate bonds or covered bonds, like in the case of the European Central Bank, but basically printing money to buy stuff. And 12 to now growing to $13 trillion, it's a lot of external fakeness that has come into the market, and that's one of the reasons why, if bonds are being bought and therefore their yields are staying low, the cost of money or the cost of creating more debt is easy for governments, and it's easy for corporations to continue to do. If someone said to you, hey, we're just going to give you unlimited money and you don't have to pay interest on it, do you want it or not? I mean, yeah, right? I mean, you know, and that's what's happened. It's happened on a government level, it's happened on a corporate level, it's happened because that's what central banks have coordinated to do. And in the wake of 2007, 2008 was the first time that the sort of G7 central bank coordination really happened. And this has been the longest time and the first time that it has continued. And so the place where money has gone, where some of your investments have gone, has been into the stock market, because there's nowhere else to go. Because the flip side of being able to borrow money at nothing, whether you're a government or a company, means that as an investor, you don't get any return from investing in the government or investing in these companies. So where do you go, and where do they go? Well, companies go into the market as well, because they now borrow money at nothing or close to nothing. They have it. They have two choices. They can pay people higher wages, or they can buy their own stock. And so their no-brainer is, well, we don't have to pay people more. We don't have to necessarily grow organically. We can make ourselves look really good by buying stock. So the other side of what's happened and why the markets are so high is because a lot of this debt has been raised by companies. They turn around, they buy their own shares, And that share buyback has been also at historic levels because that money has come in so cheaply at historic levels. And that kind of distorts the markets as well. You have this other external supply of money coming into the market. And that's all well and good as long as this is continuing. It's like, it's flying into Heathrow. You're either in a holding pattern or you're going down into land. But when you're in the holding pattern, which is somewhat what central banks have been doing, the activity doesn't really change. And when it's coordinated across countries, you become what we have today, which is a world where the cost of money is effectively zero for developed countries, for the G7, and it's a higher cost for emerging markets or developing countries. It's a higher cost to raise money within Europe if you're coming from Italy or you're coming from Greece or you're coming from Spain than if you're coming from Germany. It's just that here there's also, there's an ECB that has been controlling the overall cost of money and has been supplying the market with money to buy bonds and to choose which bonds they buy. And the ECB has chosen to buy bonds from the higher grade countries, bonds from Germany to help banks like Deutsche Bank, as opposed to as much bonds from Spain or bonds from Italy or so forth. So there's been a distortion that has also happened in the level of how well countries are doing because of how much money is going into them, because of how the central bank has stepped into this economic role and not just a monetary role. It's one of the reasons, and there's a lot of them, and we could have a whole other day conversation on this, why Brexit happened. Because on a certain level, even though the Bank of England is doing exactly what the ECB is doing in terms of keeping rates low and buying government debt, it's doing it a little bit less. I mean, if you just look at what the Bank of England is doing for the UK, they hold about $500 billion worth of mostly government debt on their books, which is a pretty high percentage of the full gilt market. The ECB holds about $3 trillion worth of various Euro bonds and corporates and covered bonds and stuff on their books. The Fed holds about $4.5 trillion worth of US Treasury bonds, of government bonds and mortgage bonds on its book. And the Bank of Japan holds about $4.3 trillion worth of mostly JGBs or Japanese government bonds on their book. So if any of that were to unwind, and this is where the risk comes in, the choices that these banks, central banks made to collaborate or collude, depending on what word you want to use, I use collude, someone more optimistic might use collaborate, depending on what they do to unwind this or exit from this strategy, there could be a tremendous fallout onto any of the bond markets, because if all of a sudden the cost of money starts rising, and now the Fed has already hiked rates by 75 basis points starting in December 2015, and just with the latest hike this March, and a hike along the way in December 2016, it starts to increase the cost of money. It starts to increase the cost of servicing some of that debt. Now, as long as the Bank of Japan and the European Central Bank and the Bank of England are not doing that, so they're maintaining rates at zero or negative as they are in Europe and as they are in Japan, the net, everything's in that holding pattern. So the Fed can look like it's raising rates because there's real growth coming into the United States and use that as a reason. But they're doing it very incrementally, which means they don't really necessarily believe it, or they're just kind of putting toes in the water and saying, well, we'll do this and we'll see what happens. As Steve mentioned, what happened last year was when the Fed raised rates in the end of 2015, all of a sudden you had a market sell-off in early 2016. And the Fed freaked out and said, okay, well, we're not going to continue to do this anymore for a while. Markets went down. The ECB came in and went more negative. The Bank of Japan went in and became more negative. Markets went back up, and all of a sudden everything was fine. And we've had this sort of uptrend in the stock market since then, because all this money continues to be injected into the market from the central bank policy. And then, of course, we had Trump come in. And one of the reasons I don't actually do slides a lot now is because Trump could just like tweet something and it would just change anything. So I don't bother now. I'm American. But that reflation, I think you called it trade, you know, the idea that somehow our Congress is going to approve a lot of infrastructure money is already kind of been shown to not be the case. I was in Washington last week, so I live in LA now, so I was in Washington last week, and then I went back to LA, and then I came here, so there's a lot of time zone stuff in my head. But when I was in Washington, the budget was basically put out for discussion, and discussion means there's a lot of people arguing in a lot of hallways and sort of horse trading, and the administration wants to have much more money on the defense policy. It wants to cut money to the arts. I mean, there's all sorts of like things happening at the higher level within the halls of the House and the Senate, or our two bodies of Congress. There's much more detailed trading amongst the different Congress people, like I'll give you this if you give me that. So a lot of that was going on, but there was ultimately not a lot in that budget that actually related to infrastructure spending. So the promises of growth, and one of the reasons that the Fed came in and actually raised rates, and we had this very accelerated upswing in the markets at the end of last year after Trump was elected and in the beginning of this year, really as of last week was proven not to have manifested. So there is some risk in general that the most recent acceleration, regardless of what central banks are doing, could actually unwind or go back to a holding pattern for a while, even go more negative, simply because it's being proven now that what he said and what's actually been presented doesn't necessarily relate to what can happen. And this happens in Washington all the time. I mean, everything that's said and everything that happens, I mean, they're complete polar opposites a lot of the time. But in particular, what motivated the uptrend has been shown not to happen. And the other thing that motivated the uptrend is banks themselves. So the banks that were at the center, particularly the US banks that were at the center of the 2007-2008 crisis, which have been helped so much by the Fed, and for which all of these other central banks have had to be co-opted by the Fed so that money in general can stay at a zero rate, and all of the manifestations of what happens after that with more debt and a higher, artificially higher stock market, is they've outperformed the market by 3 to 1. So even in this Trump reflation trade, there's been, they've outperformed the S&P by 3 to 1. So the S&P was up by 10%, or the Dow, the US market was up by about 10%, 12% just since Trump came in and we started talking in the press and in financial press about what could happen under him. And banks, the big banks, Goldman Sachs, Morgan Stanley, JP Morgan, they were up about 33%. So that was, if you're going to do the reflation trade, that would have been the one to do. And the reason why that was happening, because there was this perception that under Trump's administration, where a couple of my old colleagues are actually in the White House, not me, but them, have talked about deregulating the financial system further. So even though we're in this holding pattern of artificial, I call it artisanal money, even though central banks have basically come in to elevate markets and buy securities to give them this sort of lift that wouldn't organically be there, the banks at the crux of the crisis feel like they need less supervision. And again, these are the same banks that have also paid a ton of fines for actual crime that they committed into the financial crisis and then to hide the state of their books in the financial crisis. So in general, our top 6 banks have paid about $160 billion worth of fines and settlements just to get out of the crime that they committed into the financial crisis, one of which was basically manipulating LIBOR, and there were some UK banks involved in that. There was some, UBS was involved in that. There was a couple of European banks involved in that. But the point is, it was led by the US banks. So one of the reasons that went up, their stock went up, is because there is this perception that my former colleagues are going to come into Washington and deregulate them further. And I think that would be very scary, not just for banks, but for all of us, because there's not a lot of room left to continue this holding pattern. You know, then you do start to go down. But when I was there, I did feel for the first time, and I've been talking about having less risk in the banking system, or we should bring back a law that came into play in 1933. So after Black Tuesday, and into 1933, into the Depression that became a global depression. Everything starts in the US and just gets exported globally, and I'm sorry for that, but the act that was passed in 1933 was the Glass-Steagall Act, and what it did was it separated the risk that any banking institution had from the deposits and loans it had. So it could create weird securities, it could bet, it could be wrong, lots of things could happen. But because of Glass-Steagall, if a bank did those things, then it wasn't going to touch deposits and loans. And the deposits would be insured by the FDIC, by the government, so people's money would be secure. But any risky transactions that banks created would be on their own dime. And that worked to keep stability in the system. I mean, well, yeah, your slide doesn't change. This whole period. And it really wasn't until here, actually, when Glass-Steagall was repealed in 1999, when banks could go back to both retaining deposits and having the ability to create risk and to create bad securities and to leverage in the markets and lie about their positions. Well, because if you mix things, it's just easier, right? I mean, it's like organic food. I don't know what it's like here, but it's if there's places where, you know, the same farms produce food, and some of it's labeled organic and some of it isn't, but they're actually in the same farm, but there's some extra sort of thing that happens, and supposedly the soil doesn't go through to the organic side, but it stays on the non-organic side, but you don't really know. It's kind of like, but so when Glass-Steagall was repealed, I mean, this happened, really. I mean, that's what happened, because all of a sudden banks now have the ability to say, we have these deposits and we have these loans, and we're going to use them as collateral to do all sorts of other stuff. And there was a dot-com bubble and other things were happening, but also there was a lot of leverage coming back into the market, and of course that didn't work out so well. So I think, and I've had conversations now with both the Democrats and Republicans, so the liberal side and the conservative side in our government, where I feel there's a little bit of an understanding that maybe this sort of toppiness of this holding pattern where central banks are lifting things up and it's not really organic growth, and maybe it's not a good idea to let banks do whatever they want now and to deregulate them further and supervise them less. I'm feeling like even they're getting a little scared of what might happen if that occurs. So even though some of my former colleagues are coming into the White House and saying this is a good idea to do, you know, this and that, there are people that are starting to think, well, maybe it's not so good idea. So from a standpoint of investments in the market, that could deflate the level of where bank stocks have gotten to relative to the rest of the market and in general. Because if they're not going to be deregulated under that promise of the types of people that Trump brought in, then they're going to either be the same or be re-regulated, and so that uptrade is going to go away. So there's two reasons why that's both aspects of Trump could really be taken out of the market, and you could see a downfall, and you could see more risk coming in. And then the other thing is just in general central bank coordination. The Fed could continue to raise rates, but if they're doing so in the face of not real growth and not real infrastructure development and not real inflation, then they run the risk of taking sort of air out of this entire debt bubble that they started. So right now, global debt is 3 times global GDP. So there's about $325 trillion worth of global debt if you aggregate all countries together relative to the GDP, relative to official growth in the world. And that's a historically high ratio, and that's a ratio that has continued to be inflated by policy. If the Fed continues to raise rates, it starts to impact the cost of servicing that debt. So though there's been this almost 10-year period where central banks have basically pumped money into the system under the guise of helping it to grow, the reality is all that has grown is debt. And so now if you make the cost of debt higher in general, which now we're not, we're in this holding pattern, that's going to have much more of a deflation effect on bonds, which is going to then have a faster deflation effect on stocks. So that's kind of the good news. No. No, what that means is being wary and understanding the historical implications of how and why these central banks have felt the ability to do what they're doing, where the Federal Reserve comes in from the standpoint of first giving cover to the U.S. banking system, because that's how it was spawned and that's what it continues to do, and then how it coordinates with the rest of the world and maintains either a holding pattern, or if anything changes, there could be a lot of risk in the system. Now, we could also have a holding pattern for a long time. If we look at, I don't know, the number 9, it could be 2019 before we have a real dip. I mean, 1929, 1999, I don't know. But what I do know is that if things change, we're falling from a higher height of artificial money having come into the system and having propped up a lot of these markets, both in terms of, again, the creation of debt and where stocks are. And that could be a problem. The other thing, though, that's happened is there have been shifts in power that have come about because of how central banks have operated and how they've collaborated. Now, I mentioned a couple times that the G7 central banks have worked on the same team. Outside of the G7, so G20 sort of minus G7, there have been central banks that haven't been so okay with the Fed policy. And one of the major central banks that's been critical of the Federal Reserve policy from the get-go, really, has been the People's Bank of China. And the reason for that is, and they started sending out warning signals early on in this whole easing period, in this whole artisanal money era, as I call it, and saying, this could be a problem. We could increase debt bubbles. There could be asset bubbles. Things could fall apart really hard. This would not be good. And they've been very vocal about that, not just domestically within China, but internationally. And one of the manifestations of that has been a big change in how the IMF, which was spawned in Bretton Woods just before World War II ended in 1944, has positioned the currencies, the major currencies in the world, and what central banks need to keep in which currency. The dollar has been dominant since World War I and through now, is the main reserve currency, the currency that most gets transacted and traded in, the currency the central banks have to keep in case there's an emergency, as something they need to trade and something they need to use to keep markets moving. But countries like China are saying, well, wait a minute, look what they did to their financial system. Look what they've done in terms of Fed policy to the world. We don't really want to be a part of that. And the IMF, which was created effectively as one of the entities, the International Monetary Fund is one of the entities along with the World Bank to help maintain the status quo, which was the dollar being the main reserve currency, followed by, at the time, it was the Deutschmark and the French franc and the British pound, and a little bit the Japanese yen, and now the euro and the pound and the Japanese yen. But mostly the dollar is the main reserve currency, and it stayed that way. China's been able to convince the IMF, which again was on the side of the dollar and keeping things a status quo, to include the yuan, the Chinese currency, in something called the SDR, which is the standard drawing rights basket of the IMF. And all that is, it's a collection of reserve currencies. It's sort of taking the weight of each currency, so the dollar, the euro, the yen now, the Chinese currency, the Japanese yen, and the British pound all into one, and basically proportionally weighting them. So it's kind of this idea of a global currency, but not really. And it hasn't changed since the euro came into being in 1999 until this October, where it included China's currency. And that was part of this drive to diffuse power away from the dollar and the ability of the United States system to impose risk on the rest of the world. The other thing that's happened is you start to have a currency being more elevated in terms of trading more in the world, like the Chinese currency, as China's also said, well, if our currency is going to be more prolific, we need to have more alliances with more countries. And so one of the results of diffusing risk away from the United States and away from the dollar has been much more geopolitical and economically related, which has been trade alliances. So China's established more trade alliances with Russia, with a whole set of regional alliances between Europe and probably now the UK after Brexit, as well as within Asia, as well as with Latin America. So every sort of other bloc outside of US dominance has now been altered in the wake of this central bank movement. It started again because of a way to diffuse risk, but it's grown into an entire realignment of how superpowers are growing, and in going from the west to the east. And if we look at what else is happening, just strategically, just in terms of, this is not a statement about whether it's good or bad, this is just what's happening. The other thing China's been doing is buying gold to have as its own reserve. And the alliances it's been making have been with countries that happen to mine gold, which I learned last night, again, at our dinner that I'm sharing, but it was interesting, and I'm sure Claudia's going to go into in far more detail. I didn't actually know this. It just makes sense that if you're trying to diversify currencies in general, you add your currency, you get more trading done with your currency, you have more agreements done with your currency, that you're changing just the general nature of how trade works in the world. How else can you do that? Well, you can have something put into the mix. And so what China's done, and a lot of the countries with whom it's having these renewed and expanded alliances are doing, is actually buying more gold as well. And China also, with the rising population, is suggesting to its citizens to invest or keep a little bit of gold. So whether that is for investing reasons or whether that is just to diffuse away the power of the US dollar, it's something that's actually happening in a country in which the population is growing, in which there's a lot of consumption. The growth is less than it was 5 or 6 years ago, but it's still higher than it is in a lot of the developed countries. So if that trend continues and the strategy continues, it's not unlikely that we don't get back to a gold standard, but we get back to something where there's a measure of a hard asset outside of this ability to create electronic money to support a currency like the US dollar. And it just starts to at least proportionally realign how currencies operate and what countries use to pay for things and how they basically value the exchange of goods. So I think it's not like it's all changing tomorrow, but if I just look at what's happened in the last 10 years from the standpoint of countries outside of this G7 alliance saying, look, we don't like this policy, it could create a lot of risk in the market, to we're actually doing something about it by restructuring our trade ideas and also getting our currency more accepted as a reserve currency, to we're asking that our citizens get more invested in gold and we're buying more gold and we're retaining more gold. It just seems logical that the next step might be to, try to get gold included in the SDR with the IMF, or just use it in some other capacity that again diffuses this idea of just having a dollar-centric world. Again, I don't think that's happening tomorrow, because behind all of this is geopolitics. Behind all of this is the idea of power and retaining power. And so when China was doing all this, what was happening in the US, even though all of our banks were and are still really sort of hideous, even as that was happening, the US was saying, no, we don't want you included in the SDR. We don't think, you're a currency manipulator. You're just any kind of discrediting. And it's not like every central bank isn't manipulating its currency, because they all are. It's just that it became it's become a sort of behind the scenes fight. And it's a fight that's going to continue, because it's not just about currency and it's not just about the cost of money. It's about sort of a dominant power and dominant trade, and ultimately there's military implications, which is a whole separate other topic. But what that means is, just to recap, we have this period where there's been a catalyzing of change in just the general structure of trade and the structure of the world. It's manifested in different ways. It's manifested in Brexit. It's manifested in all of the inequality economically and from a power perspective within the other parts of Europe. It has manifested in this shift from the west to the east and the blocks of alignment that China is promoting. And so these things are in flux. It's produced, as Steve mentioned, this kind of nationalism from the standpoint of, well, how do we protect our countries? And I think ultimately all of that comes back to the fact that in the wake of the crisis of 2007, 2008, the Fed just did the wrong thing. And the United States government and the Fed have sort of been aligned in continuing this pattern and making it a global pattern, and there is no exit plan. So what do you do as investors? You realize that there's a lot of shift that's happening that will continue to happen on a geopolitical and changing of superpower basis. And it's going to be slow, and there's going to be a lot of pushback and fighting on all sides. I think this sort of shift towards more isolationism or sort of nationalism that Trump has talked about in terms of coming into office is likely to be what happens. I mean, one of the first things he did in his first week was alienate Mexico, which he had done during his campaign, but usually what happens after a new president is elected is one of the NAFTA partners, either Canada or Mexico, their leader visits the White House, and they talk about moving forward. And in this case, the head of Mexico was invited, the president of Mexico was invited, and they had a fight over the wall, that other topic. And he decided not to come, and there's already that nationalistic isolationism and this idea of not sort of working with the partners that are regionally connected to your massive land is part of what this administration is about. The last time the U.S. turned towards isolationism or more nationalism, or however you want to call it from the standpoint of trade and currency, was right before this crash. It was during the 20s. It was after World War I. So the history doesn't necessarily look good for that kind of an approach. And it looks worse now because at that point, the markets were still based primarily on cash, on real growth and real money going into real governments and them allocating it out to projects and to what was happening on a domestic basis. And now it's just kind of going into the market, and that isn't happening. So that's something else to keep in mind. So from the standpoint ultimately of what you do, and well, first of all, you listen to him, because this guy, I'm fortunate that I got to travel and I got to talk to a lot of people, and I really am looking forward to what your questions might be, because we've basically now dissected markets, bonds, currencies, history, crashes, private banks, central banks, and a whole sort of superpower shift, which is a lot for, what is it, Thursday morning? What morning are we on? Yeah, Thursday morning. That's the hard part to remember what day it is. But you're very detail oriented. And I think that understanding detail and understanding history is a really good way to have a platform to understanding how to be cautious and how to also grow your income when you need to, or your investment income when you need to, but in a way that's cautious. I've been talking about being more invested in cash for a while, because I see all this stuff happening, and yes, doing so would have missed the uptrade that happened at the end of last year, but at the same time, it would have also missed this 40 or whatever, 30% drop in the FTSE the time before that. So there is a volatile period that's going to continue to exist for the foreseeable future. We're either in a holding pattern, or we're in a volatile holding pattern, or we're going in a more downward direction for the reasons I was just talking about. So it helps to be prudent. And again, last night I also got convinced that, as we're talking about China and the fact that the individuals of China are being asked to invest in gold, and how the strategy of the People's Bank of China has evolved, that gold is not necessarily a bad thing. It's not something, or it's not plugging you the right way. It's a good thing to consider. Having a hard asset is a good thing to consider right now, and especially as a kind of longer term investment as all of this kind of shakes out. And then in between, just to be cautious of if you're going to be in the stock market, where you're going to be. And I'll say this, and this is one of the other things I said on the Hill when I was talking to people in Washington, is right now the banks themselves have kind of taken the foot off the gas in terms of speculating in the markets that they effectively control, because they have those relationships with their own central banks. And for example, the US banks have about $2 trillion worth of excess reserves, or basically money that they keep with the Federal Reserve that they don't need to, that it's not like a regulatory requirement, it's not like what happens in an emergency and they need to draw from it, it's just because. So they basically themselves have put a lot of money aside, and they're the ones getting all the help. So it is a good time to be wary and to sort of keep cash out of the market in order to be able to look at opportunities in the future, not to get really super burned if all of the promises of the Trump administration don't necessarily come into fruition, if more fights on a geopolitical basis rise, if the Fed decides to keep rates where they are, even expand them a little bit, and we start to get more defaults on debt, which have started to happen. They're already up to 2007, 2008 levels in many countries, and that pattern continues. There's a lot of risk that could come in. So keeping money out of the markets is really a prudent way to avoid the downside of that, and also be ready if there is a major devaluation to decide what to do next. And if you are in, to just be careful about where you're invested, and that's where the attention to detail comes into play. In areas where they will be less affected by the sort of outside maneuvering of central banks and the outside maneuvering of geopolitics and sort of superpower realignment. So on that note, I do want to thank you for listening, and also just open it up to questions from you, because one of the things that I have found is that there's a lot of uncertainty right now, and the questions that you ask and pose are really, they're all super critical to understanding and to sort of expanding understanding of what's going on and what you can do in the process of dealing with it. So.
Anyone have any questions?
Do you think it's a constraint, and how high is effectively raised rates?
All right. We just let this gentleman ask him. I'll bring the microphone to the back.
Sorry, no, it may be a political question, which you don't come over here. Which you don't have to answer, and I would understand that. But I suspect most of the people here today are concerned about protecting their capital, and will be thinking possibly what the effects of radical Islamism may have on the markets going forward. Now, I know you've concentrated and focused very much on what the historical position's been, but do you have any views going forward on how the current situation may unsettle the markets in the near future?
Well, I think in general, anytime there is a terrorist attack, it does do two things depending on the country in which it occurs. It tends to weaken the currency in that country. So from an investment or monetary perspective, like yesterday, when whether that's terrorism or whether that's something else, but it did have the effect of dampening the pound. And of course last year, what happened in France had the effect of dampening the euro. So there is an element of individual terrorist activities having, bringing in this uncertainty, bringing a sort of scare factor into the markets on a regular basis when they occur, and not necessarily maintaining that. In the U.S., it manifests in terms of the budget. So as I mentioned, the budget that came out last week wasn't necessarily about infrastructure growth, but it was in defense spending. So one area growth, a large area growth, is in the military component of the budget and Homeland Security. And there was actually a movement from the State Department of the United States where that budget would be cut, but the Homeland Security and defense budget would rise. And a lot of the argument behind that was to the necessity to fight terrorism or other things. So there's the whole power argument of generally the U.S. maintaining its military presence sort of everywhere, and there's been an upward trajectory in general of defense spending and military spending. But additional arguments that related to terrorism, and certainly the platform that Trump ran under, made their way into the arguments for the increase. So that's more of a long-term thing, because that comes in, then all of a sudden all these defense contractors are going to be making more money, and that sector is going to be doing better. And it's because of not necessarily an actual terrorist event, but the concept of concentrating on what could happen in the event of terrorism that allows that all to occur. So from that standpoint, it's broader, and then the individual acts have more of a day-to-day, week-to-week impact on markets.
Okay, thank you.
Medium term, do you think there's a constraint on how high the Fed can raise the rates?
Yeah, that's a really good question. I think there is. For some of the reasons that I've already talked about, and another one. The reasons, again, if the Fed continues to raise rates too much, and this happened Actually, I was at the Fed in the summer, not last summer, so the summer of 2015, so before they raised rates at all. So they've been in this period of not having raised rates, and all of a sudden they ultimately raised rates in December of 2015. But before that, it was like the summer of 2015, and I was speaking at the annual meeting between the Fed, the IMF, and the World Bank. Happens in Washington every year, and the topic that year was about supervising private banks and how come private banks aren't lending money into Main Street. And that was easy to summarize. I got up and basically said, because you didn't make them. Like, they don't have to. The money's coming in cheap. No one's telling them what to do with it, so why is that surprising? But it was also around the time where Christine Lagarde from the IMF was talking publicly about the dangers of raising rates to emerging market countries. That if the Fed starts to raise rates, all this debt that's been denominated in dollars with economies that are either weak or declining becomes that much more expensive to service, and you run the risk of having a global emerging markets crisis. Now, not like an old crisis where it was about government bonds, because a lot of the emerging markets have actually been infusing debt into their private sector and into corporate markets. But again, to the extent it's dollar denominated, it could be a problem. And she brought this up to Janet Yellen. Janet Yellen, the head of the Fed, kind of stepped back for a minute, and there wasn't a rate increase until the end of 2015. And then, of course, the beginning of 2016, things sort of ripped apart. But we had another one a year later. The Fed promised 4 for 2016. It only gave 1. I'm sorry, no, that's wrong. It promised 3 for 2016 and only gave 1. It's promised 4 now for 2017. So far, it's given 1. So there's a possibility it does 1 more rate increase, I think, this year. But all of this other uncertainty and Trump stuff not coming through, and the cost of emerging market debt, and the weakness of European growth, all this stuff comes into play. I don't think the world can afford, unfortunately. It'd be great if rates could have been normalized years ago. And again, these people, these central bankers don't have an exit plan. That's part of the problem. But I don't think they can move much more than 25 basis points this year, because they risk a major fallout globally.
Thank you very much.
You mentioned that you would put, or you're recommending people go into cash, but that's fine, you're in dollars. Most of us here are in sterling.
That's fair, yeah.
Had we gone into cash, we would have suffered enormously over the last few months, probably about 20%. Given this current circumstances, are we better going into cash, or are we better going into a basket of global stocks?
That's a really good question. And while you were saying that, I just recall that in the wake of the financial crisis, and also recently, that the Japanese yen has actually done quite well as a currency, relative to the pound, oftentimes relative to the dollar in the wake of the crisis. So that if one had been invested in Japanese yen instead of pounds, or if it was a currency perspective, there are better ways than simply being in cash. So maybe, now that I'm reprocessing what you've said, the idea of not necessarily a stock basket, because as like general ETFs or general weighting average stock markets as opposed to individual selections in stocks might not necessarily be good, because you will have that risk coming in. But on a currency basis, I mean, there are ways to put cash into currencies. That is a way to diversify cash. You will have currency risk, but if you do it on a basket basis, again, not in a stock market, but in the actual currency, like I think there's one, for example, on the yen called, I think it's RSX or RSY. Anyway, it's an ETF, but specifically for dollar yen, that doesn't relate to stock markets, it relates to currencies. That's more complex. But it's a way, as a percentage, it's still to have cash, because if you are in the UK and you're getting paid in pounds and you're buying things in pounds, then you do have a certain barrier in terms of what your loss can be staying in cash. But if you want to be more risky than that, or at least consider taking on more risk but potentially preserving more of the cash, a way to do that is with certain currencies. And one of them that I think has benefited from some of these movements just happens to be the yen. Even though they have more debt to GDP than like any other major country. It's totally odd, but their currency actually does well in terms of the more crisis period. So it's kind of a way to hedge as well.
Well, thank you. Would you mind if we... One more question? Okay.
Thank you. What effect, if any, do you think climate change issues and potential move away from fossil fuel industries to renewables might have on all these issues you've been talking about?
That's a really good question. And I actually covered it, and then my publisher asked me to cut a whole bunch of pages in the book I just handed in. So I cut a lot of it as well, but some of it's still in there, which is that this whole thing I was talking about in terms of China and the realignments of superpowers. One of the interesting things that's happened also, I didn't mention it yet, but is the creation of the BRICS Bank, or the New Development Bank, which is the constellation of Brazil and Russia and India and China and South Africa. And they've created a bank headquartered in Shanghai that raises money by emerging markets for emerging markets. And they've made it their mission to do that for green energy. So their first 5 transactions, or the first 5 infrastructure projects that they have raised funds for, and they did it in a way that they raised funds for each country. So each country basically in that 5 presented a project, and it all had to be either renewable or some sort of a clean energy project, and they then funded themselves. And the idea was to present themselves as a green bank. So in differentiating from the IMF and the World Bank and the sort of old school development banks, they're doing the model, but it's emerging markets for emerging markets, and it's green. So part of the sort of superpower realignment, and also that these countries like China, like India, they're dealing with these burgeoning populations as well as really being the engines of growth, and they have to deal with finding or at least more ways outside of fossil fuel, outside of oil, to continue to grow. And that was the choice they made when they created the New Development Bank. So there is an extent to which new energy and clean energy, because of climate change and also because of their own economic interests, is coming into play from the standpoint actually of where I think things are going as well. Not so much from the US, but again from the same countries that are questioning how US policy has evolved. Okay, I think that's all that we can do this morning, but thank you.